Okay, ready. Right here in our busy cities, amazing things are happening. People have jobs and industry is booming. It just feels like this growth will never end. But beneath all of the fun and excitement, something else is stirring. Everyone from big bankers to the everyday person is spending money. Oftentimes, money they don't even have. And there's a belief that nothing can go wrong. Yet, hidden problems are starting to show. Why did a time like this in the past spiral into the biggest economic disaster ever? What warning signs did we miss back then? And could something like cryptocurrency help it from ever happening again? So, in this video, we're going to go on a journey to see, can we stop the next financial crisis before it's too late? Let's start by going back almost 100 years ago. In the 1920s, life was incredibly exciting. People were driving cars, they listened to the radio, watching movies. Factories were making so many new things, and people had jobs and the money to spend. In fact, from 1920 to 1929, the real gross national product grew at an average rate of 4.2% per year, and the unemployment rate remained relatively low, averaging around 4.8% in 1923. Fast forward to today, we have smartphones, electric cars, the internet and AI. This technology is going so fast. The stock market continues to go up and up. Cryptocurrency market on its own is valued at approximately $2.4 trillion in 2004, and is expected to grow significantly over the next couple of years. It just feels like the 1920s, and it feels like nothing can stop us. But here's the thing. Back in the 1920s, not everything was as great as it seems. People were spending money they didn't have. Let's realize that. They were buying stocks with borrowed money, thinking that the prices would continue to go up forever. And by 1929, over 90% of the purchase price of stocks was being bought with borrowed money. Let's break that down a little bit. People were actually borrowing money to invest in the stock market, which had no signs of stopping, or so it seemed. And over 90% of their assets, of any given person's assets, was actually borrowed money. And here's where it gets crazy, right? The banks were doing the same thing. Banks had invested over 90% of their assets in the stock market, and that created an enormous amount of leverage where people stood to lose far more than they had initially invested, including the banks. Fast forward to today, we see a similar story unfolding, but in different forms. The average American household carries $96,000 worth of debt, and that includes mortgages, credit cards, or like car loans, student loans, all of those things. US consumer debt has reached a staggering $16.9 trillion as of 2023, with credit card debt hitting an all-time high of $1 trillion. And just like in the 1920s, many people are basically buying on borrowed money, using credit cards to fund their lifestyles and investments, and a lot of the time out of necessity. The cost of living is so high now, people have to borrow money. People have to use money they don't have. And in the stock market today, margin debt, or that means borrowed money to invest, stands at $645 billion. And that's not as extreme as the 1920s in relative terms, but this figure shows the risks people are still taking by leveraging borrowed money to chase these profits. Back in the 1920s, most people believed that the good times would never end, and they continued to invest with that reckless mentality. And still, today, despite all the warning signs of economic instability, people are still taking on debt at alarming levels. People are assuming the market will continue upwards in this trajectory it's on. And in both times, now and the 1920s, the warning signs were there. High levels of debt, speculative investment, and overconfidence in the system. Many people ignored it because they were just caught up in the excitement of it all. That's what happens when markets start to rage. People are excited, they see easy money, and there's rapid technological advancements, and it's all very convincing. The question we must ask ourselves now is, are we repeating the same mistakes? Are you feeling tired of sitting all day and feeling sluggish and unproductive? Well, it's time to transform your workspace and your body with FlexaSpot. The FlexaSpot E7 standing desk, which is the one you see right here, has been a game changer. It's got a smooth electric adjustable height, so I can go from standing to sitting very easily, and it reduces all the strain on your back and gives you loads of energy throughout the day. I'm even getting a treadmill to go under this thing so I can walk during the day as well and sit down and relax in this ergonomic chair also throughout the day. It's very comfortable. It's completely revolutionized how I've started to work in this new space. I've been using this desk every single day and it's truly incredible. And one thing I'm really good at is understanding and acknowledging build quality. This thing is built well, super heavy. The controls have never faltered or glitched or anything. The whole process feels solid and, sturdy and smooth. Very good build quality, and I've got a keen awareness of that. So I have basically no more back pain. I don't slouch anymore. I've got better posture, and as a result, I have better focus. And what's really cool is I've got this under desk cable duct that keeps all of my cables tidy. So not only are they kind of out of sight, but when I lift my desk up, none of the cables are stretching and stuff because it's all kind of nicely packed and it's made to be moved around. When you pair that with the FlexaSpot ergonomic chair that I've just talked about, you've got the perfect setup. This chair gives perfect support whether I'm sitting or leaning back during the break, and it's very comfortable, it's resilient, and it keeps me focused on the work that matters. So if you're ready to upgrade your productivity and comfort, FlexaSpot has you covered. And right now, FlexaSpot is offering a discount of up to 67% for people who click on the links in the description box below. Don't miss out on this incredible offer. Take your workspace to the next level today. In 1929, the stock market crashed and it completely fell off a cliff. Between September the 1st and November the 30th, 1929, the stock market lost over half of its value, and it dropped from $64 billion to approximately $30 billion. People who had borrowed money to buy stocks couldn't actually even pay back their loans. Thousands of banks failed after losing their assets. A few years ago, there was about 4 or 5 banks that collapsed, and it was chaos. Everyone and their grandma knew about these banks failing. Well, in 1929, thousands of banks actually failed after they lost all of their assets. Because remember, 90% of their assets that the bank was holding invested in with borrowed money. There was this reckless behavior that nothing could ever go wrong, and of course, it did. The unemployment rate rose from 4.6% in 1929 to 8.9% in 1930, and that led to what we call the Great Depression. So many people lost their jobs, their homes, and all of their savings, and it was an incredibly tough moment for millions of people. And that crash happened because of too many risky investments, too much debt, people spending money they don't have, and a lack of rules to actually keep things in check. So, could something like this actually happen today? And some experts worry that it just might.
We're back now with a look at Americans' finances as we approach the holiday shopping season. New data shows Americans are digging themselves deeper into credit card debt, which
credit card balances rose 4.6% in the fourth quarter of 2023, topping $1 trillion, according to the New York Fed.
People are not exactly rushing to pay them off.
Now, economists have actually expressed concerns over and over again over high levels of consumer debt and these speculative investments in technology and stocks and, Nvidia and AI and all of this stuff. And even many times in cryptocurrency. We can see massive levels of debt. The stock market seems too good to be true, especially if you're in tech stocks like Nvidia. And new kinds of investments really are propping up everywhere that people don't fully understand. But there is hope. Surely we have better tools and knowledge now. We can learn from the past to make better choices, right? And one of those new tools that people are talking about is
cryptocurrency.
Cryptocurrencies. Crypto, obviously.
But what even is that in the first place? I heard the most incredible explanation of blockchain by Anthony Pompliano, and I'm going to reiterate that here. It's about a game of Monopoly. If you don't know what blockchain is right now, you're going to know what blockchain is and be able to explain it to other people. So let's go. We're all familiar with the game of Monopoly. Every time you pass go, you get a certain amount of money. Well, I want you to imagine that one person in that group playing the game is actually writing down all of the transactions that happen throughout the game. Every time someone passes go, they write that down. Every time the next person passes go, they write that down. And it's all in order. Every time you have to pay rent, every time you take a chance and you have to pay a fine, all of these things are recorded on this piece of paper. But at some point, you're going to run out of space. You're tracking all these transactions, so later in the game, basically, if anyone has to rebuke what anyone else says or they don't want to pay a fine, you can say, well, you didn't pay it here, you did pay it here, and this person paid this much. It's all transparent and right there on this block here. Now, when you run out of that block, you run out of that piece of paper, you need more pieces of paper to keep on top of all the transactions that are happening throughout the game. Well, let's just chain them together, right? Let's chain them together so when we open it, it's just one massive stream of transactions all in order. And that's where we get the block as the piece of paper, and you chain them together. Blockchain. And really, that's all this is. It's a ledger, a way to track transactions in a clear and transparent way. It's also irrefutable. And because it's irrefutable, there is increased trust. So how will cryptocurrency actually help prevent the next financial disaster? And let's be clear, the features of cryptocurrency aren't just ideas, they're actually solutions designed to address the very flaws that we see in economic financial collapses, certainly the traditional ones that we've seen in the past. The same ones that caused the crash in 1929 and could lead to another disaster very soon. So one of those core problems in the 1929 crash was that financial power was centralized with a few key institutions. So when those few institutions failed, the whole system collapsed. But cryptocurrency changes that on its head. With over 833.7 million cryptocurrency users in 2024, the shift towards decentralized finance is significant because there's no single bank or government or institution that actually controls it. So the risk of this domino effect happening in the first place is dramatically reduced. The failure of one entity doesn't bring down the entire system, and this is the ultimate safety net. Now also, in 1929, risky and let's say fraudulent behavior went unnoticed for quite a long time, and it was hidden in the way the structures and the financial practices were at that time. But today, with cryptocurrency, every single transaction is recorded on that public ledger known as the blockchain, which I've just taught you about. There's nothing to hide there. You can't hide. The transparency of the blockchain makes it so much harder for actors to manipulate the markets in any way or take reckless risks behind closed doors. This means no more financial black boxes because everything is in sight. So as you can see, every problem that the traditional system has when it creates these financial collapses is actively being solved by blockchain technology as it is. But the next one is just as important. The technology behind cryptocurrency, which is blockchain, is built for security. It's nearly impossible to actually alter or fake these transactions that have happened once they're on the blockchain. So you compare that to 1929 when everything crashed. People were forging stocks, they were insider trading, and misinformation was basically everywhere. And so cryptocurrency offers a level of security that the traditional financial system simply cannot match. It makes it much harder for systemic fraud to bring the market crashing down. And this is the kind of rock-solid foundation we need for a secure financial future. And like I said, these are not just theoretical things that are happening. These are the exact mechanisms designed to tackle the core issues of centralization, transparency, and poor security that triggered the 1929 and the beginning of the Great Depression. So with these tools, with this technology, we're not just hoping to stop the next financial crisis, we're actively building a new financial system that's capable of preventing it. As always with history, it's key to learn from what has happened in the past. We have to recognize the warning signs like excessive debt and risky investments, and education is massive in this. We don't want misinformation out there. People need to understand what they're investing in. Remember, the 1929 crash was exacerbated by the excessive speculation and lack of regulatory oversight. Similar factors contributed to the crash in 2008, by the way, as well. It's the same thing. And so these things are persistent in the nature of the way humans do things. So by combining lessons from the past with new tools and new technologies like crypto, we might just be able to prevent a financial disaster. So, can we stop the next financial disaster happening before it's too late? In my humble opinion, with my many years in the crypto space and understanding the utility behind these blockchains and digital assets, not only do I think we can prevent it, I think we'll do it in style. And those who are hedged in the correct assets, who are invested, not over-invested, not over-leveraged on margin, those people who understand utility and are in the right assets will ultimately come out on top. But I am no genie and I can't tell the future. One thing I can say is that I guess we'll just have to find out. Are you feeling overwhelmed by your crypto portfolio? You're not sure when to take profits or how to plan for the bull run that's right around the corner? Or do you generally feel that you're at the complete mercy of the market with no real plan? Well, let me tell you, you're not alone. And that's exactly why I created what I've called the Blockflow Program, is to help serious investors just like you create a clear, actionable plan for taking profits in this bull run, and so much more. With my proven strategies and my very own methodologies, you're actually going to learn exactly when and how to take profits and how to plan for the wealth that's up for grabs in this crypto space. So if you're ready to stop guessing and start winning, click the link below to schedule your free discovery call and join the Blockflow Program today. Take control of your success this bull run with Blockflow.